Construction companies that are profitable on paper go broke all the time. And it's not because they underquote or run the job badly, it's because they don't understand the timings of when they get paid and when they incur costs. So in this video, I'm going to teach you everything you need to know about construction, cash flow, and financial management. I'll cover exactly why this happens, why there's a difference between profit and cash flow, go through a worked example of actually how to forecast and manage cash flow both at the project level and the business level, and then what levers you can pull as a construction company to ensure that you stay solvent. And I'll also put a link in the video description to a free cost tracking tool you can try out and use. Okay, so the fundamental issue we need to understand is that cash flow is all about timing. It's about the actual point in time of when we get paid versus when we incur expenses. This is fundamentally different to profit. Now, they're obviously heavily related, but they are different concepts. Profit ignores time. All it is asking in absolute terms, did we get paid more from our client than we had to pay our supply chain? I.e., is there a difference between the money we receive versus the money that goes out? When cash flow is asking the question, do we have the cash in our bank account to pay our bills for this week? Because it doesn't matter if we're going to receive 200 grand in 12 months time. If we can't actually pay our bills this week, we cannot stay in business. So that's why you can have a construction company that is generating a net profit over a year, but doesn't actually have enough cash to pay their bills. And that is the entire problem in one sentence. And managing cash flow is actually incredibly difficult to do it because it's a very complicated problem that is going to draw from a lot of different data sets that are difficult to manage. We need to understand the actual construction work itself and the timings of when the project is getting delivered. This is going to drive when we're able to bill our clients for the work we've completed, but also when we're going to have to pay our supply chain for things like labor, plant, materials, and subcontract costs. So to understand these, we also need to understand the commercials that surround the project. We need to understand what our payment terms with our clients is, when we can claim for certain things. And we also need to understand when we have to pay our supply chain. And then we also need to understand the accounting behind this, when we have to pay tax, all these different tax implications, and how our business overhead costs are accrued. In some ways, project profitability is actually the easy part. We know you can use estimating to work out how much it's going to cost to deliver the project, put a profit margin on this, and that's our profit. But cash flow is actually a much more complicated problem. Now, if you do want to understand the profitability problem on a construction project, then we have done a video on construction cost tracking and managing construction budgets. So I'll put a link to that on the video description because it's useful to also watch that video to better understand the content in this video. This video is going to be very focused on the mechanics of the actual cash flow itself and how to forecast and manage cash flow. All right, so let's start with a case study. This is going to be an imaginary project. I'm going to use simple numbers and examples, but we'll imagine it is a $10 million contract value. We have a 15% profit margin on. So we've got $8.5 million cost, $1.5 million profit. The project schedule is 10 months and we have 30 days end of month. We've got 10% bank guarantees, which means we need to put up a 50% deposit on those bank guarantees. So if we have a 10% bank guarantee, that's like, and with a 50% deposit to get that, that's like putting up $500,000 cash. Because of the nature of the project, we're going to be paying our expenses weekly, but we have 30-day payment terms from end of month. So we're only going to get paid for the work we've completed a month after we submit our invoices. And assuming we had to procure 500K of materials upfront, we're going to be running at around 800K of cost per month, factoring in the 15% margin. So this is, again, this is probably a realistic, if not a good construction project to be working on. Good payment terms. We have big bank guarantees. We've also got a good profit margin. So if we imagine our starting cash position is zero. In month zero, when we first sign the contract, we have to put up $500,000 of bank guarantees. We have to procure $500,000 of expenses. Then we start and do month one's work where we spend $800,000. Now, I know realistically, I'll talk about this later, the construction projects follow sort of an S-curve style. To make this simple, I've just mapped this out linearly. At the end of month one, we can make our first payment claim, which remember is making a payment claim. It's no money actually going into our bank account. So our actual cash position at the end of month one is $1.8 million down. And all we have done is make a payment claim. So no cash into our bank account yet, but we have spent, well, we haven't necessarily spent it because some of it's just locked up in bank guarantees, but we have needed $1.8 million of cash to finance the project. Then we have our month two expenses, which is another $800,000. We don't receive our $1 million from our month one payment claim till the end of month two. So we're actually $2.6 million down up until day 29 of the month. Then on day 30, we received that $1 million from our first claim and we're back to negative $1.6 million. So our worst cash position on this project is negative $2.6 million, almost 25% of the contract value. We need that much cash to finance this project under these conditions. Now, again, this assumes our client doesn't delay paying us. We don't have disputes with them. Basically, we are financing the entire project. If we map this out across the entire life cycle of the construction project, our cash position slowly gets better over time, but it is not even till month 12 when we finish the project that we actually have a positive cash position. And then again, depending on the specific contract terms around the release of security, but if we can imagine it's 24 months later, we get the rest of our security back. We don't even receive our profit margin to up to 24 months after the completion of the project. Like, I don't think people fully appreciate how much cash you need to manage construction project. We would negative $2.6 million down, and through the entire execution of this project, up until month 11, we were not actually cash positive. And again, this doesn't factor in cost blowouts, our client delaying paying us, and 100 other things that could happen. Now, this is the typical situation I would see across most construction businesses. But again, we'll talk about it as we go through it, how to actually forecast this, how to understand what your worst cash position is going to be, and then what strategies you can adopt to reduce the impact of this happening. The next thing I want to talk about is why is cash flow uniquely difficult in construction? Basically, to draw your attention to some of the key issues that you need to pay attention to when managing cash flow. If we think about, I guess, more of a traditional business like a coffee shop, you have staff on the same wages, you have your fixed costs like your CapEx for setting up your coffee shop, purchasing your machinery equipment. Then you have some sort of variable costs like buying the beans or your staff's wages. You might also have rent, and then you have some sort of product range, but everyone pays the same way. Everyone's just tapping their credit card and paying. The money's going into a bank account. You're receiving the cash when someone's actually doing the work. If we contrast this to a construction project, you have multiple different projects. Every single project will have different payment terms, different payment cycles, different clients. Every project will have different retention percentages, so different percentage of each claim will be held for different periods of time. The actual amounts you're going to get paid each month varies depending on the quantum of work you're doing and the specific contract terms that surround it. It's going to be contingent on a whole lot of unknowns like weather, certain conditions, like whether you did 5,000 meters of trenching or 4,000 meters of trenching, whether you had unknown conditions, there'll be variations associated with it. And then if for whatever reason you make a claim, but you don't give enough documentation to substantiate that, maybe your claims get rejected. So there's all these variables around how you're actually going to get paid. And on top of that, while you somewhat know that you're targeting a 10 to 15% profit margin, your actual profitability is going to be very difficult to determine because there's going to be things like variations that significantly changes. There's going to be uncertainty in your actual costs. Your price of materials may go up significantly from when you quoted the job to when you actually locked in the contract to when you needed to procure them. The actual completion date and when you're going to get your security back is hard to determine. And then projects just go bad or you have difficult clients. So there's a whole lot of factors that actually significantly impact the overall profitability. On top of that, you may think you are owed a variation for something, but your client might actually reject this. You get into a dispute. You don't know whether to record that as forecast profit or even just it's going to be a cost blowout because you're not going to be able to recover those costs from your client. So there's so much uncertainty as to the actual contract value and then the actual costs you're going to have to incur. And then as I've already mentioned, you have the issue of performance security and retention that actually hold up costs. And then there's so much input data into this as well. It's scattered across different projects at different stages, then different spreadsheets and different registers. And again, a lot of the key drivers of this are just uncertain to begin with. Like how much it rains in a certain month can actually drastically impact your cash flow depending on who holds the risk for inclement weather. So, long story short, there is a ton of different variables that can make it easy or difficult to forecast cash flow, and it is so contingent on uncertainty. Now, so I've elaborated why this is particularly hard in construction. Now I want to talk about how to actually begin to go about doing this. And the first thing to understand is that when we're talking about financial management, there's really three data sets we care about: our business overhead costs, our project specific costs, and our project revenue. We can only get a true understanding of our business's cash position, which is what actually matters, our ability to keep paying our bills, if we understand these three numbers: our business overhead costs, our project costs, and our project revenue. And these are the numbers we carefully have to track and understand to really understand the overall financial position of our project. Because at the end of the day, all the money that comes into a construction business is payment from a client. So it's actually the revenue side of things is all what we have quoted our clients to deliver the project and how much they're agreeing to pay us, which is going to be a combination of the original contract lump sum plus approved variations. Then we have our project cost, what it is actually costing us to physically do the construction work. So in the same way we quote $10 million to deliver a project, we're also saying that this is the scope of works we are going to deliver for that $10 million. If it's a lump sum project, the risk of the cost of the construction works entirely sits with us. So our cost to deliver the project is going to be a combination of our labor, plant, materials, and subcontract costs, and this is our responsibility to manage. If you can imagine, a construction business is going to be made up of multiple projects. So when we put all of those projects together, we get our project portfolio, the sum of which will be our total revenues and our total costs. But sitting outside this project layer is we have our non-specific project costs. These are our business overhead costs, things like estimating and tendering new work, senior management who aren't allocated to a specific project, our office and IT assistants. These are purely a cost, and they're going to be some monthly recurring costs for offices or whatever, and they're going to have to be allocated as a percentage to our project. So we're going to have to recover from the difference between our project revenue and our project cost. We're going to have to recover our business overhead costs, sometimes referred to as corporate overheads, as well as anything extra left over is going to be our profit. So the key point to note here is for the business to keep operating, we have to be able to pay our project costs and our business costs. Okay, so we've got our business overhead costs, our project costs, and our project revenue. They paint a picture of our project cash flow. The fourth thing we really need to understand, and this is going to be very location dependent. So whether you're in the US, Australia, UK, it will vary significantly, but it's understanding tax. When we actually have to pay things like GST, payroll tax, company taxes, because that's the other thing that is going to impact profitability. But the key point here is with your tax obligations, the government doesn't actually care whether a client has paid you yet. If you have been paid for work and you haven't set enough aside for tax, you suddenly get a $60,000 tax bill from the government. That is going to have massive implications on your cash flow as well. So the fourth thing to really understand is tax. All right, so the next thing I want to talk about is how to actually forecast and manage cash flow. So there's really two sides to this. There's your business overhead forecast, which is purely a cost. And then we have our project cash flow, which is going to be a combination of our revenue and our costs. Because remember, all our revenue as a construction business is going to come from the project level. The sum of all the projects is our project portfolio. And then the business overheads are going to be purely a cost. So I'll go through a project example, then I'll talk about how to build out an S-curve, how to compare your revenue and cost. And then when we get a combination of projects, this becomes our portfolio. And then sitting on top of that, so when we have our project portfolio, is how we factor in our corporate overheads. Okay, so the first stage of this is we have our project budget, and we want to time phase this. So for example, our example construction project, we have preliminaries, civil, structures, building envelope, mechanical services, electrical services. We have a budget associated with each of these tasks, but it does not have any time phased against it. It is just a static point in time. During the execution of the project, we plan to spend 420 grand on civil works or $580,000 on the structures, but there is no time component to this. So what we want to do with our costs is we want to time phase them. We want to spread them across time and assign the months within which the work will be completed. So if I show you a very simple example of this, say for our project, we have mobilization and preliminaries and concrete works. we know our prelims, if it's a 6-month project, we know our prelims are going to be incurred every month, regardless of what happens. So we spread those over the overall project duration. Our concrete works is planned in month 1, month 2, and month 3. So we spread these over these months, because that's when we're going to incur the costs. We have our structural steel frames is planned in month 2 and month 3. We spread those across those months. You get the message. But the way we can do this is only from understanding the construction schedule. We need to properly understand exactly when each of these tasks are going to be occurring, because that is when we're going to incur the cost, and similarly, when we're going to be able to bill our client for the works. So it's a very simple concept, but you need to consider the program when doing so, and you need an accurate schedule and an accurate budget to get the information to basically time phase your bill of quantities. Now, we can do this again with both our revenue and our cost, and I'll talk about in a second how to factor in the different payment terms. But for now, we're just ignoring the actual payment terms behind it. When are we doing the work, and when are we incurring the costs? As an extension to this, you also need to be forecasting your actual anticipated costs, because that is going to impact your cash flow. You need to actually understand your planned true costs for doing the work. So unless you have variations, your true revenue is going to be fixed. But obviously, if you get variations, you have to factor those in as well as forecast variations. But your true cost is probably going to change, because again, it's based on an estimate of the actual cost of the work. All right, once you understand the timings of your revenue and expenses, you can determine your actual cash flow. This is obviously going to be the difference between the two numbers, but factoring in when you are actually getting paid and when you are actually paying your expenses. Now, this depends a little bit on the makeup of your actual cost. So for example, if you're subcontracting out your concrete works and your subcontractor is on 30-day end of month payment terms, and you're on 30-day end of month payment terms with your client, the point in time where the money is leaving your account is actually the same as when you were getting paid from your client. But if the majority of your costs are labor, which you pay weekly, you're actually paying these costs weekly, but then you're only invoicing for the work you've completed at the end of the month, and then you're only getting the cash 30 days after that. So when you actually go and map your revenue to expenses, you need to understand for the different components of your costs, what is the composition of labor, plant, materials, and subcontract. Then the third element you need to factor in is your actual retention. Because if your client is holding back 5 to 10% of every claim, then that is another sum of money that you are invoicing the client for, but it's not going to reach your bank account until, again, depending on the contract terms, the end of the project, and then potentially after that, the rest of your security or retention at the end of the defect liability period, which might be 12 months, it might be 24 months. So this spreadsheet is a very, very simple example, but it is saying how much we are claiming from the client, which is basically a percentage of, or it's based on how much work is getting completed each month, depending on how it sits in our schedule of values or our pricing schedule with the client. Then it is deducting 10% for retention. So we have what is actually getting paid into our account, and then we're only factoring in the money we've received with the 30-day payment term. So we make this claim in month 1. The money actually enters our bank account in month 2 because we've got 30-day payment terms. But again, we're assuming our costs, when we look at this, our costs are incurred in that month, because assuming we're a self-performed business. But again, you would need to do further analysis as to the breakdown of this cost. And the easiest way to do this, again, is with your schedule of values. The labor and materials component, you might pay upfront or as you do the work, but the actual subcontract component of that might get paid a month later. So this cumulative cost, you need to pay attention to what these numbers are actually made up of. As labor, plant, material, subcontract, they all have different payment terms associated with it. When you have both of these numbers, your revenue and your cost, that is when you can create the S-curve. The S-curve is when you basically take the program of any construction project. You'll notice at the start, it genuinely starts slow, where you're just mobilizing to site, starting some early works. Then you reach the middle phase of the construction project where there's multiple tasks occurring in the same period of time. We're spending a lot of money, and then it tapers off towards the end as we begin demobilizing and we're just fixing up defects. So an S-curve is when we plot out the timings of the costs we've incurred and the money we've received. When we look at this S-curve, for example, we can see that at the start of the project, we are incurring costs at a greater level than when we are receiving payment from the client. And it is only at month 5 that our cumulative cash flow is going to exceed our cumulative cost and we're going to become cash positive. And when we look at this, the number we want to find is our maximum negative cash flow, because that is the maximum dollar value we're going to need to finance the project. This is referred to as the maximum deficit. We want to find the point in time where our cumulative cash in, the difference between our cumulative cash out and cumulative cash in, is the most negative, because that is the number we need to finance the project. We should be 1,000% sure that we're going to have the cash to cover before we even decide to proceed with the project. Now, the next thing you need to understand is, yes, that is the amount of cash we need to set inside, but that number has actual profit and interest associated with it. If we have to borrow that money from the bank, they charge us interest. But that $1.8 million we need to finance this project, that is something we could use to buy more plant and equipment, invest in more estimators to pursue more projects. You have to really understand the opportunity cost associated with that number, because you have to plan your whole business around it. Because fundamentally, deciding whether or not to proceed with the project, if you don't understand what that negative number is, you don't understand the capital investment you need to commit to the project. And there's a real chance that you haven't allocated enough money, or it might not be the smartest decision. Now, the final stage of this is, yes, you forecast cash flow at the start of the project, but then this becomes a live document you keep updated. As variations come in, as things change, as clients push back payments, you want to keep this information live so you always understand the impact on this number, what your worst cash position is going to be. And again, this only works if you are also doing this in parallel with cost tracking. So I've done a video on construction cost tracking and the steps you should follow, so feel free to watch that. But this entire system only works if you actually understand what your true costs are and you're forecasting them and maintaining them. So again, cost tracking is more about profit. Cash flow is about the timing of expenses. Now, what about your business overhead costs? Well, they're actually quite easy to forecast. The thing you have to understand is how to allocate them to a project. So business overhead costs, they're generally recurring and ongoing costs. You generally don't have big lumpy spends, but if we're thinking about a typical construction business, we'll have an estimating team, senior management who aren't allocated to a project, office, IT systems, corporate insurances, health and safety, finance and admin, additional marketing costs. All we do is look at each of these costs, what we're likely to spend each month, and calculate our total monthly overhead cost, and then to determine what this is as a cumulative overhead cost throughout a year. So for example, for this business, across a 12-month period, they're spending $2.3 million. The way you allocate this to a project is you look at your total annual overhead costs, you work out what your planned annual revenue would be. Again, this is going to be a little bit of an estimate, but you can look at what projects you've secured, what you're likely to secure based on forecasting out some sort of win rates across your project. Then to look at what this is as a percentage, your total annual overhead budget as a percentage of your planned annual revenue. You then have a percentage, which is your overhead as a percentage of revenue. For this business, it is 7.7%. What this means is every construction bid this company does, they need to factor in 8% or 7.7% for their corporate overheads in addition to their profit. So out of the revenue they're getting from their project, automatically 8% has to be set aside to cover these total monthly spend of their ongoing business. Anything left over on top of that is going to be profit. So you actually use this to set your margin on construction projects. Basically, you want to keep your overheads as low as possible. And if in addition to keeping them low, you want them to be variable and as much as possible project-based. So for example, if you don't have consistent estimating work, it might be better to use contract estimators and you only use them when you need them, rather than hiring a full-time estimator that sits idle for a lot of time. And then in those busy periods, you still need contractors. Do you really need a permanent office, or can you get by with remote work or using sort of the variable office spaces where you can just hire a desk whenever you need them? It's really, you want to keep this overhead cost as small as possible, because you're going to have to keep paying that regardless of whether you have money coming in the door or not. The next one is going to be more about revenue, which is pretty simple to understand. And I think most contractors are aware of this, but you really want to structure your quotes or your pricing schedules with your clients to front load the early claimable stuff. For example, if you have a fee in there for design or pre-construction, you want to put as much money into this as possible so you're claiming early. For example, if you can take some of your preliminary costs and move them into the design fee for the project, you can claim extra costs early. The thing you need to be careful about with this approach, and you have to be little bit aware of this problem is often your client will use your pricing schedule to calculate variations that you are owed. So if your pricing schedule doesn't reflect your true cost, you can bite yourself a little bit by doing this strategy. For example, if your design fee is super high, but your prelims are super low, and then you want to claim an extension of time, but you have low prelims, it can be hard to justify a big EOT cost. So you have to be a little bit careful with this strategy. You just have to think about it. And it is why a lot of this bidding and practices around it is a little bit of a game. The other thing you can do is just negotiate and push for better payment terms. Push for 14-day payment terms. I know a lot of big construction companies default to like 40 or 45-day payment terms, but they automatically approve anybody who asks for 30-day payment terms. The other big lever, if we go back to the example I spoke about of the $10 million project, is you can see what a big impact security and retention has on this. So you always want to try and negotiate some sort of the minimum security possible and the shortest defect liability period. Okay, then we can talk about what you can do on the cost side. As I spoke about, subcontracting is actually much better for cash flow than self-performing, and you can align your subcontract payment terms with your head contract. So basically, you're just the middleman, but you're not actually having to put up cash for people to do the work. Obviously, subcontracting is more expensive than self-performing. The other one you can do is you can really understand the program and what are the drivers, and basically, can you actually physically do some works earlier to bring your cash collected forward? And then you also have to be looking at cash at the portfolio level and just understanding certain periods of time. For example, at Christmas, like December and January, where if you're a self-performed business, you might not actually be doing as much work because there's such a long period of holidays, but you still have to pay everyone wages because they're all full-time. So it's very important to understand your actual cost and when you're going to be incurring these expenses, even at a portfolio level, so you don't get caught out with things like this. The next one is tax. You just have to set aside tax into a separate account and not to see it as cash. I know me personally, I've made that mistake for my business and I've been caught out with it. How much cash you have in your account, if it's set aside for things like GST and other tax owing to the government, you have to be very careful about it. Now, when you actually do run into a deficit, it's important to understand the different mechanisms you had to solve this. You can use debt or equity. You can invest cash into the business to cover this, but obviously that is going to come as an opportunity cost of other investments you could do, or you could use interest. But really, debt is obviously much more riskier because you're going to have to start paying interest with this, and then the bank is going to have a claim to what is owed. So look, I guess treat debt with caution. Focus much more on the project levers you can pull. Low overhead, structure your pricing schedule so you're claiming as early as possible. And then your project costs, obviously you want to keep them as low as possible. Again, spoke about that ton in the cost tracking video. From timing perspective, subcontracting out work is probably the biggest lever you can pull to delaying at the point in time when you have to incur costs. As I said, you can check out Mastt and the cost forecasting and cash flow tools within the software. You can try that completely for free, but also if you want to check out the cost tracking video, then I'll put a link to that below as well.